The Dollar Dilemma: How Trump's Tariff Gambit Rattled Global Finance. The unraveling of a safe haven. For decades, US Treasury bonds and the dollar operated as twin pillars of global finance. Investors flocked to these assets during turmoil, trusting their stability. Yet in April 2025, this paradigm shattered. The 10-year Treasury yield spiked by 0.5 percentage points in a week, the steepest climb since the 1980s, while the dollar index plummeted 3%, hitting decade lows against the Swiss franc and euro. George Saravellos of Deutsche Bank captured the gravity. We are entering uncharted territory, a simultaneous collapse in the price of all US assets. This divergence defied economic orthodoxy. Higher yields typically attract foreign capital, bolstering the dollar. Instead, investors fled US assets entirely, seeking refuge in gold, which soared to $3,200 per ounce, yen, and European bonds. The Treasury market, with daily trades exceeding $1 trillion, faced liquidity strains reminiscent of the 2020 dash for cash as hedge funds scrambled to unwind leveraged positions. The tariff tsunami, Trump's Liberation Day gamble. The crisis stemmed from Trump's radical trade agenda. On April 2, 2025, dubbed Liberation Day, he invoked a national emergency to impose a 10% baseline tariff on all imports, with rates soaring to 125% for China. The move aimed to erase the US trade deficit but ignored warnings from economists like Lawrence Summers, who predicted it would treat the global economy like a problematic emerging market. Chaos in implementation. The rollout was chaotic. Tariffs shifted daily via executive orders, bypassing congressional oversight. Countries like China faced erratic escalations. Initial 34% duties jumped to 125% within days after Beijing retaliated. Politico likened the measures to the Smoot-Hawley Act of 1930, which deepened the Great Depression. By April 9th, the average US tariff rate had ballooned from 2.4% to 22.4%, disrupting supply chains and igniting fears of 1970s-style stagflation. Market revolt, bond vigilantes strike back. The bond market's rebellion was swift. Investors, spooked by policy unpredictability, demanded higher yields to offset risks. The US government is clueless, declared one economist, as Treasury auctions saw tepid demand. By April 9th, the 30-year yield recorded its steepest three-day rise since 1982, pushing borrowing costs for mortgages and corporations, the hedge fund amplifier. A key accelerant was the unwinding of basis trades, complex bets on interest rate differentials between treasuries and futures. Hedge funds, leveraged up to 50-1, faced margin calls as yields spiked, forcing fire sales of $140 billion in bonds. Ed Yardeni noted, "The Trump put vanished. The bond market took charge," referencing the erosion of investor faith in government backstops. China's financial nuclear option. Beijing's retaliation extended beyond tariffs. With $761 billion in treasuries, China threatened a financial nuclear option, mass bond sales, to cripple US borrowing. Though unexecuted, the threat alone rattled markets. If treasuries lose their safe haven status, global finance crumbles, warned Ernie Tedeschi, a former Treasury official. Simultaneously, China halted rare earth exports, vital for tech and defense, signaling a multi-front economic war. Panic at the White House. The 90-day pause. Facing a bond meltdown, Trump abruptly paused tariffs for 90 hours on April 9th, exempting all but China. The reversal, orchestrated by Treasury Secretary Scott Bessent, followed urgent warnings that soaring yields could spike debt servicing costs by $300 billion annually. Trump downplayed the retreat. "People were getting yippy, but I solved it quickly." Markets rallied briefly, but analysts dismissed it as a band-aid. Citi noted remaining tariffs still posed substantial burdens, while PIMCO held recession odds at 50%. The global ripple effect erosion of dollar dominance. The dollar's 7% annual drop signaled deeper structural shifts. Deutsche Bank noted rapid de-dollarization as central banks diversified reserves into gold and yuan. Even stalwart allies like Japan trimmed treasury holdings, fearing US fiscal recklessness. The euro, once left for dead, surged to 3-year highs as capital flooded EU bonds. Trade partners strike back. The EU mulled tech taxes targeting US giants like Apple, while Southeast Asian nations accelerated UN settlement systems. The US brand is damaged, concluded ANZ's Richard Yetsenga, as nations questioned reliance on dollar-centric trade. Long-term fallout, a weakened financial order. The 2025 crisis exposed existential threats to US economic leadership. Trust deficit, erratic policymaking eroded the predictability underpinning dollar demand. As former Fed Chair Janet Yellen noted, once credibility is lost, it's hard to regain. Debt dynamics. With debt to GDP exceeding 130%, rising yields threaten a doom loop of higher deficits and inflation. Strategics.